this one is a perfect example, right? Let's say you're scalping. Okay. Let's say you're scalping calls. You're like, yeah. You failed to look down here and you got a call. It pulled below VWAP. You're trying to put in a stop, trying to put in a stop, trying to put in a stop. You got your stop. Look how much damage was done.
Yeah.
It's a 1 minute candle, by the way. That's 1 minute. That's 1 minute. If
Yeah.
you would have did it right and you bought it, whatever, your stop would have said like, hey man, that's 10%, dude. Right. If you guys are trading in here, you can use the contracts. This is the contracts price. It's always delayed and it's never on point with what's going on, but it gives you a close to, right? So if you're buying up here, you can see, let's say you paid $1.35. Let's say you paid $1.35. You already know how much you can put in a stop because you can see it, right? So you can use this to your advantage if you guys want to chart off of the contract pricing, right? You'll see if it pulls and pops what it kind of does. Does this make sense?
Yes.